Hi, everyone. My name is Elsie Wu. I'm the mortgage broker at Abundance 99 Inc. Today, we're going to be talking about tax considerations for a real estate investor. We are very excited to have Ben Koala with us. So, Ben, would you please introduce yourself?
Yes, as Elsie mentioned, I'm a CPA and I've had my practice since 2012. I also have my real estate license and a number of other licenses. So have worked with a lot of real estate investors throughout the years. It's very typical that when a person goes from simply having their primary residence to having a piece of investment real estate, that they realize that, oh, this is beyond my capability to manage in tax. I need professional help. So that is often the catalyst for why somebody comes to a CPA in the first place. That is a large amount of our clientele, our real estate investors.
So, let's dive right into today's topic of tax consideration for a real estate investor. I'm going to specifically focus on people who live in California and are thinking of investing in California. And I'm also focusing on dual income couples who get W-2 paychecks. And I'm using the example of $300,000 combined annual income. They only own their primary residence. We're focusing on people who are looking to buy their first investment property, and that investment property purchase would be around $1.8 million, which is the median price of a coastal single-family home in California, and looking at 30% down payment or 70% loan to value for $1.26 million loan amount, and an interest rate of 8%. That's about the market rate for interest rate rental properties right now. That means $100,000 in mortgage interest in that first full year, 25,000 in property taxes, and we're assuming 4,000 a month of rent from this single family home rental. So, Ben, help us understand what are the tax implications and how do we think about these?
Right. So, for those that in this hypothetical, we assume that they own their primary residence. So, those taxpayers are probably familiar with the limitations due to the Tax Cuts and Jobs Act on the deductibility of the mortgage interest and property tax on their primary residence, where they have that $750,000 mortgage limitation and the $10,000 state and local tax deduction limitation on their primary residence. That does not apply to rental real estate. You could have a $750,000 mortgage. You could have a $3 million mortgage. It does not matter. There are no limitations on the amount of mortgage interest that can be deducted against rental income. Same thing with the property taxes. There is that $10,000 state and local tax deduction limitation on the Schedule A. The Schedule E, which is the form that the IRS uses to report rental income and expenses, has no limitation on the amount of property tax that can be deducted. So all expenses, and again, for your primary residence, all you can deduct is mortgages or property tax. For the rental, you can deduct mortgage interest, property tax, utilities, insurance, whether that be hazard insurance or any other types of insurance. There, you can deduct your HOA, your repairs and maintenance, any and every expense that goes into the rental property. You can take as a deduction on the Schedule E. So there are no dollar value limitations on what can be written off on the Schedule E. However, if all of your expenses exceed all of your rental income and thus generate a net loss, then that overall loss can be limited. So rental income is seen as passive income. And it's important to distinguish passive income from your active income. Your active, ordinary income includes your wage income and pension, Social Security. All those are bits of ordinary income. The rental income is ordinary income as well, but is considered passive. But it's a hybrid of passive and active income. So ordinarily, passive income. Let's say that I invest in a publicly traded partnership let's say that some oil reserves out somewhere, and I am a 0.001% owner, and I get a K1 from this limited partnership. If that is a loss, I can only deduct losses to the extent of passive income. That's just it. If my losses are more than my income, it's not deductible. With rental real estate, because I understand that there is some level of activity in being a landlord, they do allow you to deduct some losses, up to $25,000 in losses. However, there's an asterisk on that, because if your adjusted gross income is 100,000 or more, the IRS starts to limit how much can be deducted, and it gets prorated up until 150,000 of AGI, at which point none of that loss can be used to offset that current year's income. So for this hypothetical couple in California, it's very probable that their adjusted gross income is over 150,000. So what that means is if their total expenses exceed their total rental income, then none of that loss can be used to offset your other income on your return. But that loss is not lost forever. It gets carried forward on a Form 8582 where the passive losses are recorded, and it can be used in one of three ways. Number one is if your income in a future year is positive, that would get wiped out by that loss you've been carrying forward. Or if your income ever drops beneath 150, it can be used. Or if you sell the property down the road, those passive losses you've been carrying forward go to offset the capital gains. So if you had a $500,000 capital gain when you sold that property 10 years later, but you're carrying forward $300,000 of losses you were able to use, your gain is now only 200,000. So the only way that you lose that loss is if you die, because your heirs would get the stepped up basis at that point. But at that point, you're dead. So what do you care, anyways?
Right. Okay. So would you also talk a little bit about depreciation recapture?
First, I'll introduce the topic of depreciation. So depreciation is what the IRS has prescribed as a appropriate way to recognize a significant expense of an asset over a more appropriate period of time. So it's not the layperson's definition of depreciation where something loses value over time, because typically real estate actually appreciates in value, not depreciates in value, as opposed to a vehicle, which, unless it's a collector, vintage vehicle, usually depreciates in value. The amount of time that the IRS has given for residential real estate is 27 and a half years. So just for simple math, if you had a property with a basis of 275,000, you would have 10,000 of depreciation expense every year over that 27 and a half year time frame. That is an on paper expense, not a cash expense. So in that same hypothetical number, that $10,000 expense every year, you could have $10,000 positive cash flow, but zero taxable income, because that depreciation wiped out that net income before accounting for depreciation. So the land is not depreciated. Improvements on the land are depreciated. Typically, for most properties in California, you would allocate maybe 70-30, 80-20. It's kind of arbitrary. You don't have to go look at the property tax assessment and say, okay, this is the exact math they did on there. It's just generally you want to leave some amount to land. You don't depreciate the entire value. So if you had $1 million property, you might say, okay, 800,000 of it is attributed to building, 200,000 to land, and therefore your basis for depreciation is 800,000. So even 27 and a half years later, you would still have a $200,000 basis because the land itself is not depreciated.
Oh, so if I, as a married couple with dual income, W-2 income, if I cannot use that negative every year on my Schedule E to offset my W-2 paychecks, do I have to take depreciation?
You have to take depreciation. However, again, if your rental expenses, including depreciation, exceed your rental income, and you're already over that $150,000 threshold, then it becomes that passive loss that gets carried forward. So if it didn't help you in the current year, then it can help you in a future year by either offsetting future years' positive income or offsetting capital gains. So depreciation recapture, which is something that is worth addressing here, is when you sell your property down the road. Let's assume you've been able to deduct the full amount of depreciation up until the time that you sell, and you bought a property for $1 million. You sell it for $1.2 million. Assume it's been a rental property the entire time. There's never primary residence. You have in that a $200,000 capital gain. But let's say you also had 100,000 of depreciation up until that point. So therefore, your basis has been reduced by that 100,000 of depreciation. Your gain is really 300,000, comprised of $200,000 gain and 100,000 depreciation recapture. That depreciation recapture is taxed differently than capital gains. It's treated as ordinary income with a max rate of 25% on the federal side. But let's say that there was 100,000 of depreciation, but you never were able to use that depreciation to offset your ordinary income because of the loss limitations, and therefore that 100,000 is going to show up on that form 8582 passive loss limitations, get added back to your basis, bring your basis back up to 1 million, and therefore your gain is now only that 200,000, assuming there was no other passive loss carry forward. So you broke even before accounting for the depreciation. Not that the math ever works out that perfectly. So if you don't get the benefit of the depreciation on the front end, it doesn't hurt you on the back end. It's just neutral. Does that make sense?
Yes. Yeah. And this is why people need a seasoned CPA who really understands real estate and rental properties, because this is complicated.
And
I'm going to shift gear a little bit. What about people who are thinking of buying a new home, moving to the new home, and keeping their existing home as a rental? What are the tax considerations there?
so one consideration is when we're talking about depreciation, again, your basis is typically your purchase price, including closing costs, plus any improvements. So while it is your primary residence, make sure you're keeping track of all those improvements because those get added to the basis for that calculation of depreciation. But let's say you bought the property 20 years ago, know that your depreciable basis is that purchase price and closing costs plus improvements. It's not the market value at the time that you convert it to rental. That's not relevant for the calculation of depreciation. Simply purchase price, including closing costs, plus any capital improvements you've done over the time that was your primary residence. So market value, not relevant. But another thing to note is that your expenses on your primary residence, if you owned it for a while, very likely are much lower than if you were to buy a brand new property today. If you bought the property 20 years ago, you've probably paid off a significant amount of mortgage. With the way that the amortization of a loan goes, your mortgage interest is probably quite low. With the Prop 13 in California, your property tax is probably very low. So you have a lot less expenses overall, therefore better cash flow. So it could be a very good investment wise because the market value of the rent is based on the market value of the property, but your expenses, especially the mortgage interest and the property tax, might be much lower than buying a new property today. So it could be a way to get a good cash flow on your former primary residence.
Got it. And so does property tax transfer with me to my new home? And do I get a new property tax on my old home that I've turned into a rental?
So you can maintain the same property tax limitations on the converted rental property as far as it's not going to continue to go up year over year, and you're not able to transfer your property tax basis if you're going to be treating that former primary home as a investment property. You would have to, sell it and then move to, if we're talking about, Prop 19 transfer of property tax. That would you would have to have the higher property tax basis of your new home that you purchased.
Got
And
it.
that you can't, but you are able to keep the low property taxes on your former primary residence.
Good. Got it. Okay. So for people who own their rental homes, would you talk a little bit about what happens when they sell? 1031 exchange? How does
Mhm.
that?
So when you sell your investment property, Uh, generally speaking, there are no exceptions to capital gains unless you sell it where it's been your primary residence for at least 2 out of the 5 years preceding the sale. So if you have your primary residence, you move out, you rent it for 2.5 years, and then sell it, you do have the homeowners exclusion of 250,000 per person or $500,000 for a married couple to exclude the capital gains. So if you have only rented it for a couple of years and you decide, hey, I don't like being a landlord, I don't want to deal with this anymore, you want to figure that out within 3 years of moving out to get that exclusion. Otherwise, once that 3 year window has passed, you no longer get that exclusion. On the other end, if you bought a property as a rental from the very beginning, it's been a rental property for 10 years, and you decide you want to sell it, assuming you don't have the primary residence exclusion, all of the capital gain will be subject to capital gains tax. So capital gains, you have short-term capital gains and long-term capital gains. If it's going to be for more than 1 year, which typically most real estate investments are going to be for more than 1 year,
Right.
it is long-term capital gains, which is as low as 0%, as high as 20% federal income tax on capital gains. The thresholds for that vary whether you're single, married filing joint, married filing separate, head of household, different thresholds for that. For most California people who would be owning rental real estate, they're probably going to be in at least the 15% long-term capital gains bracket. There's an additional net investment income tax, which is additional Medicare tax of 3.8%. If you're single over 200,000, married over 250,000. So the maximum amount you can be paying federally is 23.8% on long-term capital gains, with that capital gains rate of 20% plus the 3.8% net investment income tax. And the maximum you can pay on California is 12.3% because California has no special rates for capital gains. It's all treated as ordinary income. So your calculation for how much of your gain is your sales price minus your purchase price minus the closing costs on both sale and the closing cost on the purchase. Then you also have to factor in, the depreciation that is reducing your basis even further and therefore increasing your gain. And you get to add to your basis improvements to the extent that those improvements haven't been depreciated, because the improvements are also depreciated over generally either 15 years for some improvements or 27 and a half years for some other improvements, depending on, and that's for your CPA to help you figure out how your improvements are depreciated. But once you've done all that math to figure out what the net capital gain is, that is taxed at as high as, again, 23.8% federal, as high as 12.3% California. Now, there are other ways to offset that capital gain other than the homeowners exclusion. One, as was brought up at the start of this prompt, is a 1031 exchange. A 1031 exchange is referring to the IRS tax code that allows for this specific tax deferral, where you take your basis in property A and you move it to property B. It only applies for investment real estate. It can't be primary residence for primary residence. It has to be investment property for investment property. So let's say you bought property A for $500,000. Its basis is now 300,000 due to depreciation and whatnot, but the market value is $1 million. You could buy property B for $1 million, transfer your $300,000 basis in property A to property B, and have no capital gains upon that sale. Now, you have to follow certain guidelines. You have to work with a qualified intermediary, which is a third party that holds the proceeds from the sale. of property A. So when you sell property A, you cannot constructively receive the cash from that sale. It has to go in a trust account through that qualified intermediary, and then that is used to purchase property B. If you ever actually constructively receive that cash, it voids the 1031 exchange. So you have to make sure that you go into the 1031 working with that qualified intermediary from the onset. You also have to identify the new property within 45 days and close within 180 days. So there's certain rules, and if you're working with a good real estate agent and qualified intermediary, they'll make sure that you follow all those rules so that you can meet the IRS guidelines. And assuming you've done all those things correctly, now your basis in property B is 300,000. Assuming that new property is going to be rented out, that 300,000 is now your basis for depreciation on property B. You treat it as rental property, and you can do 1031 exchanges until your dying day. You could do that from property B to C to D, and you can keep deferring that tax for the rest of your life from one property to another. It does not have to be one property for one property. Let's say property A is worth $1 million, and you have properties B and C that are worth $500,000 each. You can 1031 exchange. Oh, I just made balloons on my screen. You can 1031 exchange from property A to both B and C, and then you would just have the basis in property B and C would be split from based on what the basis was in property A, or you could have properties A and B that are worth 500,000 each and exchange them for property C that is worth $1 million. So it doesn't have to be one property for one property. It can be one for two, two for one for five. Just has to be real estate for real estate.
Yes. And we have a couple of videos that we have created on our channels about some of the more advanced approaches of doing exchanges, like selling 4 properties to buy one, or buying them in different sequences so that you can extend the 45-day identification period. So that would make it easier and more appealing for real estate investors.
Another strategy that I've seen is, as I mentioned, it has to be investment property for investment property. However, it just needs to be in good faith. And the parameter for that is it needs to be investment property for at least 2 years after the exchange. So let's say that the real estate investor has a rental property that they would have no interest in moving into, and they are approaching or in retirement, and they have their primary residence that they're thinking of, hey, I want to move to another property in retirement, but not into my rental property. So they might do a 1031 exchange of their highly appreciated rental property for another property that they want to move into in retirement, rent out that property B for 2 years to meet that good faith effort of this was a proper 1031 exchange. And then after 2 years, they can, end that lease with that tenant, move into that property as their primary residence, live in that into retirement into their dying day. They never have to pay any capital gains tax because upon their death, their heirs get the stepped up basis. And so that can be a strategy to buy a primary residence through a 1031 exchange, as long as it does not begin as your primary residence. Yeah, it can't be for at least a couple of years.
Right. And there's another tax strategy where if you lived in your home for many years, 2 out of the last 5, and then in the most recent 2 years, it was a rental, an investment property, then you can potentially take the $500,000 per couple homeowners tax exclusion on the sale of the property, and then do a 1031 exchange on the balance of that property sale of your former primary residence, and that will be tax free or tax deferred,
Advantaged, yeah.
tax advantaged for that sale. So there are
There's all sorts of strategies, and we always tell clients before you make any major financial decisions, consult with your CPA first,
yes,
because it's a lot easier for us to advise you before than to tell you the mistakes you made after the fact when we can't fix them anymore.
exactly. So Ben, any other tips, advices you have for newer real estate investors?
Uh, when it comes to the 1031 exchange, some people might, say, "Hey, I just don't want to be a landlord at all, but I have hundreds of thousands of capital gains that will result in potentially hundreds of thousands in taxes. There are some other options as far as you can exchange into what's called a Delaware Statutory Trust, where you pool in with hundreds of other real estate investors into sort of a mini REIT, real estate investment trust. It's just under a different name, under certain legislation that allows a 1031 exchange. And you just find a reputable management company. You want to do proper research and due diligence because you're entrusting that investment management company to do things for you. You no longer have hands on. You are not involved in the management anymore. But for some people that are in retirement that just don't want to deal with the fuss of being a landlord anymore, that could be something that is worth exploring.
Right, definitely. Ben, thank you very, very much for spending your time with us, sharing with us your wisdom and experience. And if people have questions, they can contact you at the information that we show on the screen. See you at the next segment.